And we're live. So we're back today with the commodity report. Very glad to be back here chatting with you guys about commodities, interest rates, anything macro, basically, we kind of talk about on here. Because it all has to do with the market, the overall market. And especially as a commodities trader, you got to know what's going on with the market. So Kevin and I got a question the other week, just kind of generally talking about inflation. I'm going to look for that question. But as I'm looking for it, if you're the person who asked the question, feel free to drop it in the chat. We can't remember exactly what it is, but the question is generally, what are we thinking about the Fed, interest rates, how it's going to play out in the market, this whole thing that just happened last week? What are you thinking about it? You know, it's what we talked about the other week already. Inflation is moving higher slowly, very slowly, but just enough to kind of tip the Fed's hand. And then interest rates are also rising as well. So, Kevin, what are you thinking about this situation and how should traders be positioned for it?
Yeah, I think with the Fed meeting that we had last week, what was actually was it this week? Last week?
Last
It
week.
was last
Yeah,
week, right?
Wednesday. Yeah.
Sorry. Yeah, the holiday is kind of
Monday.
messing me up. Okay, so um, uh, what was actually very interesting about that whole Fed meeting is the updated summary of economic projections, right? Where they raised their expectations for core PCE up to around 2.5% for the year. That's going to be their target for the year. And then they moved up GDP growth by only 10 basis points, or what have you, right? So, you know, the long suspicion that I've had is that the Fed actually had a soft target at 2.5%. I think that the SEP actually does confirm that. And I think that they're also still concerned that if they tighten, or if they would have tightened or did not cut soon enough, that it could actually have a deteriorating impact when it comes to the labor market. And so they're trying to find a fairly decent balance. It was a weird cut because everything that they did not want to have happen in that SCP, as far as the rate of change to the upside, happened, and they're still cutting, right? And so it was a very big different message, very unique message. I think Powell also kind of fumbled the ball several times on the press conference, which he rarely does. And I think that was the reason for the sell-off here. Once again, we kind of go back and say, though, that a lot of the inflationary pressures are on the services side, not so much on the goods side. And we're going to have a back and forth, I'm sure, when we're talking about softs. But a lot of the softs guys are not built into CPI, and or they're very small components of them. So we have to just be mindful of that, at least for now. But the stickiness of inflation when it comes to insurance, when it comes to shelter, housing, which, you know, you can make the debate that there's a problem there when it comes to just calculating that. That's here nor there. We play the game how the game is played, and unfortunately, it's still sticky. Transportation services, airfare, things of that nature are actually very sticky. And so, you know, when you kind of go about it looking forward, and my expectation for 2025, if we're going to have some grandiose like outlook type of conversation here, I think the biggest wild card that's on the table is going to be China. People have been saying that for the last couple of years. And I know it has not come to fruition, but I still believe that China is the biggest risk to inflation right now. And if they do see any type of reacceleration or aggressive acceleration in consumption trends, then I think that's actually when you will see a pop in a lot of the energy commodities as well as the metals themselves. And I think that's actually one of the biggest risks for first half of next year. I'm not sure if I could say it's going to be a Q1 type of scenario, but I would say by Q2, if you do get that China story there, I think you get some pressure when it comes to some of the major commodities that people kind of focus on for right now. And that's going to make it very difficult for the Fed. And we kind of have we talked about 3 cuts or 2 cuts next year, right? Like they're basing in 2. They just recently did another cut. Could they do 2 cuts and still kind of stay restrictive? Yes. 2 cuts is really not that much. They could have maintenance cuts where they split them up, 6 months apart. No one would be the wiser of that if they wanted to do that. And then, could they actually cut more? They could. Do you have a risk of actually a rate hike next year? I think it's a very low probable risk, but I think there is a risk out there if you kind of get that first half of the year scenario that I'm kind of alluding to here with China. And the reason why I say it's not so much China just full on broad demand. It's the China story looking better, and then people trying to front run it when it comes to price. That's the key on trying to get a commodity cycle type of move there. And so Could they raise at the latter half of next year? They could. They would put them in a very rock and a hard place, and I would say equities would fall off pretty substantially if that were to be the case. That's kind of where I'm at when it comes to the inflationary picture right now. Nothing looks uber bullish on the energy front when it comes to consumption trends right now, right? Nothing looks uber bullish on the grain front so much, right? There's some bright spots when it comes to export demand, but we don't know. It's really hard. I'm going down a tangent, man. It's really hard to see or try to quantify what the uptick in export demand has been. We get the weekly reports, right? And if that's a pull forward of potential tariff risk, or if that's true organic consumption trends coming out of China, especially, right? I think everybody right now is discounting it and saying, hey, people are trying to get ahead of tariffs and stocking up rather than, hey, there's actually some consumption trends that are changing in China. And I wrote about that. You can find it on my Twitter page under the articles. I wrote about that like last week or 2 weeks ago, right? But out of all of the other commodities, the bigger ones, once again, energy and grains, I don't see anything that's really, or even the metals, copper or silver. I don't see anything that's really like seeing uber bullish right now, but that can change on a dime. What do you guys think?
I'm curious in your thoughts, like XLE, XME, the energy stocks and metal stocks have gotten blasted pretty well, but
Yeah.
I think part of this narrative also is these emerging market currencies should be getting the shit kicked out of them. And I'm seeing the CEW, the Emerging Market Currencies ETF, it still can't register an oversold reading. It hasn't since the bottom in 2022.
Do you have that chart up, Sam? You want me to bring up your charts?
Yeah, bring it up here. So this is what I'm looking at. It bottomed here in 2022, oversold, and it hasn't registered an oversold reading this entire bull market. So
I did find that interesting as well, Sam. Just kind of looking at that. Yes, it's sold off pretty heavily lately, and that's one thing to continue to pay attention to. And it looks very similar to how energy has looked lately as well. So I do think that there's something there, right? Like I think here's the thing that I'm looking at. If I look at, and this is the thing when I post stuff and people look at it and go, okay, what is Jason exactly talking about here? And I should probably be better at explaining some of these things as well. But when I'm posting, hey, this is what all of the central banks are doing, what we're really looking at is how that could affect their currency and how it can affect the US dollar. And then you can kind of dissect the macro after that. And what we're seeing is a lot of these emerging market countries that are in this ETF aren't really lowering rates at the same rate as the Fed, or they're not lowering rates at all. So that's going to give them a little bit of a boost. And once again, it's how does that play out in the overall commodities market? And I think Kevin's exactly right. Looking at China, understanding what we're going to see going forward from China, and then people front running it. Because really, like trading is front running. Like that's why people say price actually leads everything. It's like, yes, it does, but it's because people are front running what move could be coming up later. But yeah, the China story is very interesting. But there's so many things going on in the macro markets right now. So what are we thinking about inflation, Sam? Do you have any charts on inflation that you want to take a look at?
right, like I've mentioned the DBC SPY ratio on here not long ago, like stocks versus commodities, and there was a pretty nice momentum divergence going on here, but they're blasting it. It's making new cycle lows today. So that's not really bullish, in my opinion, on the inflationary narrative. So
No, and that's the thing. I want to also preface all of this inflation talk, which we're not seeing what we need to buy most of these things yet. Like, a lot of people hear us talk and they think that we're talking about always buying commodities. Kevin will come in tactically every week and be shorting or longing based on where we're at, and also give the fundamental picture. Mine are trend models that are more longer term, and Sam's looking at the intermarket charts right now. So all of these are saying the same thing, which is long term. Like we don't have any signals to really buy commodities. Where we are seeing inflation, and like Kevin said, like the softs, yeah, we're trading, you know, coffee. Coffee's just raging to the upside. Cocoa's raging to the upside. A lot of these that aren't in the CPI are moving. Okay, that's great, but that's not going to make the Fed make a move one way or the other. And that's what Kevin means by when he says, hey, the CPI is built this way. So what we're really looking at is trying to figure out where we're interested in buying, when we're going to get in these things again. And right now, for me, I don't see anything that's saying, hey, it's time to buy oil here. I don't like to buy bottoms. I don't think that's a good move, especially in commodities. I'd rather wait till it breaks out to the upside. But Kevin, I want to pass it to you. What's the fundamental picture? You know, let's make the bullish case. Let's make the bearish case for oil, energy, gasoline. We'll take natural gas out of it because it's its own exorcist case most of the time. So what are you thinking about the fundamental picture for the energy commodities?
I mean, they don't look. I'm sorry, that CEW. I'm still looking in it. It looks like they're investing in like money markets of the currencies. I would have to look because it doesn't look like it's that bad. Because
there's a lot of
currency
treasuries in there. It kind of gives a weird picture. You're right.
Yeah, because like if you kind of look at the emerging market currencies, they've gotten destroyed for sure. Brazil's currency has gotten hit pretty hard. If you're looking at the Mexican peso, that's also gotten kind of a hit. You can even look at some of the major currencies, and I think that's why you're seeing the dollar index actually strengthen in the manner that it is, right? The euro is close to being at parity. I think it's only like, what, 3 cents away from being at parity, if I'm not mistaken. The Canadian dollar is ripping to the upside. Some political things that are happening within the country. And then if you kind of look at the trend, the USD CAD, or if you look at the Canadian dollar, usually in 2016, is that the Canadian dollar? All right. And yeah, that's the Canadian dollar, right?
Yeah, it is.
Yep.
Okay. All right. So can we pull that thing back like another 10 years or so, if possible?
Sure can.
Okay. 2016. In 2016, let's put our mouse over that. All right, so 2016, we saw kind of, and this is going to be inverse, right? But when you see this chart kind of go, it doesn't matter. However you want to have it, it doesn't matter, right?
I was
chart moving to the
because of futures, but yeah, it doesn't matter.
Yeah. So this means, so this is USD over CAD, right? So as that line goes up, that means the US dollar is getting stronger. Canadian dollar is getting weaker. What happened in 2016? Can you highlight that one for me? 2016, we saw a pop. 2020, can you highlight that one? We had another pop. 2024, let's highlight that one. We got another pop. Every 4 years, what's the trend? It's easy to spot, right? And so I think, people are kind of freaking out about the Canadian dollar right now, and rightfully so. It is hitting some pretty key areas of resistance when you're looking at this pair, or you can say it's a bottoming if you look at CAD/USD. But at the end of the day, I think this is more also positioning for the uncertainty and the unknowns of policy decisions over the next 6 months from the United States government. It's not outside of the trend of, hey, 2016, there could be a risk. 2020, there could be a risk. 2024, there could be a risk. And those are all election years. So that's one thing to kind of be mindful of when you're looking at a lot of these currencies. Eurozone's just not doing too hot when it comes to economic data. The yen is probably going to hit 160 again. I don't know when, but it looks like it's damn near on its way to try to hit 160, which is not something you would like to see. And I think the only thing that we have, the question mark when it comes to the yen, earlier this year, we had the carry trade risk, which was a very hard one for us to be able to map out because no one really that carry trade is mostly like private equity and certain institutions within Japan, right? You don't see it really on balance sheets of a JP Morgan or a Morgan Stanley or a Goldman Sachs. It's just not how it goes, right? So there was estimates of $1.2 trillion worth of risk. That was like the minimal risk that was being priced out there. Others were, if you took the derivatives in aggregate, and the carry trade risk could have been up to $12 trillion worth of risk. give or take. That's with all of the derivatives exposure that was being assumed. And then just so happened in a matter of a week, apparently we had a covering and we had no more risk. I'm being, and that's a joke, by the way, if you can't tell my sarcasm, because it was completely BS. But how much did people actually kind of go back and double down into that carry trade, right? That's the biggest question mark that I have right now. And how much risk do we have to the upside? You could kind of look at that technical chart. So that's what's kind of going on. I know you asked me about energy markets, but I kind of want to highlight this one because this is
I love this.
the currency markets are the largest markets in the world, right? It ain't U.S. equities. It ain't trading gold. It ain't trading Bitcoin. It's currencies. It's $4 trillion, $4 to $6 trillion worth of notational flows in the foreign exchange markets on a day-to-day basis. And so this could have a material impact when it comes to not only equities, but also in the commodity markets too. And a strengthening dollar is not giving any help when it comes to the energy market as a whole. It's not giving any help when it comes to the wheat market. It makes those products a lot more expensive on an export basis. And so that's going to be that risk there. But if I had to take a shot, and I think, Sam, you had a chart about this a couple of days ago. Maybe I'm wrong about your thesis here, but if I had to take a shot, I would say we're more peak dollar right now than the start of the dollar continuing to ramp up. And I think that there's more of an ability for next year for the dollar to break down. I think that also coincides with yields hitting around 5%. On the upper end of the bound and then range bound out, and we lose treasury vol next year, which would be great, because if we have dampening treasury vol, then the markets are able to price that out, and that's going to be actually a tailwind for equities, in my opinion. So, somebody asked me the question this morning, could you see a 7,000 on the SPX with 5% interest rates? And I think the answer is yes. It just depends on how we get to that 5% and if we stabilize at that 5%, because that's all we really care about when we're traders here, right? We want the certainty of price or the certainty of yields. We don't care really what the level is going to be, because you got to measure it on basically a curve basis. What is the 10-year doing relative to the 2? What's the 10-year doing relative to the 30? So on and so forth. And then that's how you can kind of map out valuations and trade setups. And so I'll kick it back, because I thought that was actually a little bit more important than my energy trade. That's going to tell you that nothing looks great. And so that I thought that would be a little bit more food for thought. What do you guys think? And then XLE. Oh, by the way, I'm sorry. XLE 92, dude, fade at 92 every time. Look, you can go back in history. XLE is such a messed up index, and the valuations of a lot of these companies, people who utilize XLE as this energy trade to get exposure. But at the end of the day, crack spreads haven't done jack squat. Right? They've been very depressed. So why are we pushing up equity valuations in energy companies if these energy companies are not making money on the margins at all? In fact, the margins have literally pretty much collapsed this year, going from a $32 to $35 crack spread to going down to around $16. I don't even know where it's at right now, but I know it's probably around $16, maybe even $13. What are we paying? What are we paying up for? Right? What are you paying a multiple for? Nothing. There's no reason why. So this is actually a breakdown that should have occurred a very long time ago. And I was talking about this, got to be a month ago, right before Exxon's earnings. And I was like, dude, it doesn't make any sense with these valuations and what the profitability levels are for these companies, just using basic 3-2-1 crack spreads. That's not even accounting for the collapse of margins within the chemicals business, which has been lackluster pretty much across the board. And I always scratch my head when that bad boy gets to 92, 93. I'm not saying every time, things can change, but when it gets up to 92, $93, more oftentimes than not, it's a fade. If you can stomach 2 weeks, 3 weeks, 4 weeks on the trade, you can go out, buy put options on it, maybe even doing diagonals or even calendar spread. I don't really like calendars, but you could do diagonal put spreads, get some of that premium cheaper, and then boom, it pulls back down. And now you're kind of looking at a value range. Maybe I probably would wait just a tad bit more, but you're looking at a value range. If you want to get exposure to energy, you have micro contracts, you got the bigs, you got micros for crude, you have all of the tools that are necessary to get you pure exposure, rather than an energy company that differs on the internal dynamics of their business. If you want exposure, there's more than enough things. USO options, micro options. You literally can trade micro options or options on the micro crude contract micro crude contract is very liquid. It's actually a really decent. I mean, you're still, there's probably still a 2 cent, 3 cent spread, but you're talking about $1, a penny per, per move. I mean, it's not that bad. So that's my 2 cents. I'm gonna kick it back over to you.
No, I love it, and it is something Kevin talked about because we were seeing breakouts in some of these areas, and Kevin mentioned that there wasn't much more upside, and he mentioned go for the pure plays, and we talk a lot about on things on here, and it's hard to a lot of people don't trade futures, so it's hard to really like understand how to do it. But there's so many ETFs and vehicles that I didn't have when I started that I would have been trading commodities a long time ago. Right at the beginning of me learning how to trade. At the beginning of when I started learning how to trade, there just wasn't many options. If you wanted to buy something like sugar or cocoa or coffee or any of these, they didn't exist then. Now we do have some of them. Now we have funds that are ETF funds that handle a lot of commodities like DBA. So there's a lot of things to do. So you can be involved in a lot of these commodity trades in ways that are more pure plays than just always trying to buy the ETFs or the indexes generally. And also, Sam, can you bring up that XLE chart again? And we do volume by price on there. So I had a thought on what Kevin said about that 92 level.
I don't have that tool on here.
Oh, you don't? Okay. I think on TradingView it is just volume by price. I think there is a volume by price thing.
You looking for a VWAP or a profile?
Profile. Let's see. If there isn't, I can still explain it, but
You have a volume profile in there?
Yeah, just explain it, Jason.
okay, so let's just explain it. So if we're just getting up to those levels, what you're seeing and what Kevin's also talking about, if you just look, and you can do this with everything, what's the level that the most bars are hitting most of the time? And so most of the time, either that's going to be support or it's going to be resistance. And that's a very important thing to think about, because if that's going to be support or resistance, those are times you can buy, you can go long above those levels. You can go short below those levels. You could trade the range. You just that understanding of the ability to go long and short because of the amount of bars, the amount of volume, the amount of open interest that's in those areas is a great way of understanding how to trade things. Kevin's always posting great things about that generally, like when we're talking about the S&P options market. Kevin's always posting levels, and so there's a bunch of ways to understand these levels. Longer term, you could do something like I'm talking about. Shorter term, you want to do something more like what Kevin's talking about. Kevin has some great videos on his page. Also, if you guys haven't seen that, make sure to go to Kevin's page. I've tagged him like a million times. So if you guys are on my page, you can always find Kevin very easily. So definitely check that stuff out. But really, I do like what you mentioned here, Kevin. I do agree with you at the moment. It's not the place to be. We just all exited the trade. Which has been on in the portfolio for a long time. The long-term portfolio, it's literally been since 2020. We've been in that trade. We just exited it.
You can make a case for it. You can make a case for it. I mean, if you're somebody that says, hey, maybe there's a retracement bounce to it, and this goes to the different time frames, right?
Mm-hmm.
For me, It's like, do you take a shot for a week and try to see if you could swing something? You could do that. Or you can wait to see if this is actually going to buy. Is this a middle of the road type of trend, right? A support area sitting at around 100, or I'm sorry, I'm looking at Exxon, but is this the middle of the road type of trade here that could still run to the downside? Because it does actually look like it's breaking that little channel, right? I'm back on XLE. That's all good. They all look the same. Or do you take a shot and try to see if the trend's going to be intact? One way or another, I think a longer term, you wait. You take Jason's approach there, but.
Well, longer term for me, I'm out. I'm out in the futures portfolio. We've been out of the position for a little bit, and now the long-term portfolio is right near getting out of the position. So it's a longer term, and my long-term portfolio, it's a retirement portfolio. It's based on taxes, so our time frame is usually over a year. So we're really trying to be very long-term in that. We haven't hit 52-week lows in a very long time. So it does look okay in that very long-term time frame, but I also agree with Kevin. If I'm a swing trader, which most of you guys are, and if I'm a short-term trader, like there's nothing to do here. You get out. Yes, you could try to trade it for a bounce, something like that. But if you're just trying to trend follow this thing, it's just not the time. And also, I want to pass this one to you. So since we're talking about energy stocks, and Sam, you might have something to say about this as well, which is Warren Buffett came in and started buying Oxy again. Did I hear that right? I was on vacation. I think I just saw that as
He
I was
bought
doing.
like a $500 million. It was a piker purchase.
Yes.
They
So
moved
like,
the
you know,
stock basis by like 5 cents.
something I do on a random Monday morning. All right, sounds good.
Yeah, I think it comes down to multiple time frames. So like you guys were talking about, I think Warren Buffett just has a long-term bullish thesis on the economy, and if that is true, then crude oil should participate, and Occidental should be a beneficiary of that. But like I think the XLE and energy stocks just in general have been holding up in spite of terrible refining margins and all of that. Like, all of what you said, Kevin, is true, but I think they were kind of anticipating this level holding, but now they're puking it out, and maybe that is the heads up that this crude oil chart is about to break down as well. What do you guys think about that?
So my thing on the crude oil side is I definitely see a couple things, and one is the chart I've been talking about a ton. And let me see if I can bring this thing up, because we've talked about this a million times on here, that commodity to bonds ratio, and we're starting to finally see this thing move to the upside. And so when we're looking at this, like we're finally seeing this, if you just kind of draw a pennant on this from those highs in 2023, you're or a diamond pattern, even better. You're kind of seeing we're starting to break out of these levels. So as we're kind of breaking out of these levels, like, and either to me this signifies a couple things. And somebody, I think his name was Dan M. He brought this up the other day, which is, his idea was that most likely yields would come down and catch down to oil at some point. And my thought is that at some point, probably oil will catch up to yield. So it's two different sides of it, but I'm not wed to either idea. I do think that Dan's idea could be right, or my idea could be right. But I do see that we're kind of seeing that yields are ripping so hard to the upside, and bonds, TLT is the inverse of bond yields. Yields are ripping so hard to the upside that it's putting so much pressure on this ratio that we're actually seeing commodities moving higher in comparison, because oil really hasn't gone anywhere. Like, everybody keeps making these big proclamations of what oil's going to do. It's either going to break out, or it's breaking down, or it's the end of the world. And it's like, oil just hasn't gone anywhere. That's the true story.
One of the best compressions and volatility we've seen in recent history.
So here's the best trade ever for this type of scenario. And most people are going to look at this and go, well, Jason didn't say anything. No, I'm telling you everything right here, right now, but you're going to have to trade it like an actual trader and not think about it like an analyst. And trading like a trader means if oil breaks down here, I want to be a short. I want to short this thing because that volatility compression. Can you go back to the oil chart you had, Sam?
Sure.
Thank you. That oil volatility compression that we're seeing right at the end is so tight and so rare for something like oil that this thing's going to move, and that movement's going to be big. And then once again, if it breaks to the upside, we start sustaining above these next levels, 75, we start to get above there and really sustain up there. I want to be long it. So we're completely in between two things. So I think right now the best trade is neutral here and wait for this breakout. Breaking out above, that 75, 80 level, whatever your level is. It's if you're looking at 50-day highs, 100-day highs, 200-day highs, you're anywhere between those levels. Drawing a trend line just like Sam has it, another perfect way to do it. And this also looks very similar to your chart that you brought the other day, Sam, which was on cocoa. And so it's much more shorter term for cocoa than this one. But once again, if this thing starts to break to the upside, it's not going to stop. That's going to be hell of a trade, one way or the other. And I know people love to just know directions, but there is no direction here. We could make Kevin and I could sit here, and Sam, and we could all sit here and create a bullish or bearish thesis for oil. However, there's the only thing to do here is to wait for it to break one way or the other, and then that's the thesis. And I think the best thing I ever learned about that was Bruce Kovner and Market Wizards. In Market Wizards, Bruce Kovner talks about the USD to Canadian dollar pair. And he's one of the best traders ever. To me, he is the best trader ever. He's understanding that there's a fundamental picture one way, there's a fundamental picture the other way for that pair. And then it just moves to the upside. And he goes, okay, cool. That's the way I'm going on this trade. And it's because you don't know exactly, nobody knows the future. And trading and the price action is always going to tell you somebody knows something before you do. And that's why technical analysis works so well, because you don't have to know the future. It's impossible to know it anyways, but you can go, okay, the price is breaking up this direction. The bullish thesis is probably the right thesis then. And so that's how I would trade it.
For sure. I like erring in the direction of the underlying trend. And like we saw a massive uptrend from 2020 to 2022. And I'm looking at the weekly momentum in the lower pane here, and it has failed to register an oversold reading. So I think the benefit of the doubt is with the bulls until proven otherwise. Plus, you have the second wave of inflation. I think that chart is so good. It all goes back to that. We're looking at these consolidations in commodities versus bonds. Maybe it's just a continuation pattern.
So Kevin, what's your thoughts on just oil then generally? Let's take the stocks out of it. Let's take energy stocks out of it. Let's just talk about oil and anything else you want to talk about. I know you got to leave pretty soon.
Yeah, I think for oil, the trade is still a scalp, right? So you scalp in at around 67 and a half, 67 and a quarter, sell out at around 69 and a half, $70 to be exact. And I think if you continue to do that until the trend either breaks to the downside, which I honestly like looking at this chart setup, even if this is a weekly, right? But looking at this chart setup, it don't look great. It looks like it wants to flush, unfortunately, or it might be trying to do a little bit of consolidation. But the thing that I'm a little bit more concerned about is that it still makes lower highs. Even if you're seeing these little minor pops to the upside or what have you, you get really, really granular. It is still making lower highs on a relative basis here. So I would say if you are a scalper, 67 and a, not a recommendation, 67 and a half, 67 and a quarter, scalp it in, try to get a buck out of it, buck and a half. I mean, you're talking about per contract. If you're trading the bigs, you're talking about $1,000, $1,500 per contract, right? And then you sell it. And then you can also look at you can look at the crude options too. So on a relative basis, crude options are actually really cheap. So if you want to kind of go that route and define risk, you could do that. Goods and bads when it comes to that, right? If you're trading the bigs or if you're trading the micro, you can put stops in. You got a trailing stop in, blah blah blah, right? Which are always nice to have. When you're trading the options, you can't put stops in, right? So you got to either be at your location or your desk, or you got to have some pretty decent confidence. But the options are also another route where you can kind of amplify some gains, but also know that you could lose 100% of the trade going in there. But like this morning, at the money calls are going for like 20 cents. Like this morning, 25 cents. That's $250, right? On a trade that's having realized vol of around 75 to 85 cents right now, right? So you do the risk reward. This is just a perfect example of saying, okay, if the implied move is 20 cents to the upside, 20 cents to the downside, that's 40 cents, right? But you actually have realized vol of around 80 cents to 90 cents a day. You got to pick the right side of that trade, but the options actually are paying off. IV is not really being priced into those options. So I think that scalp is the trade until either this fades and breaks down, and or we do see a move back to the upside. If you bring up a monthly chart, and you don't have to do this, but if you bring up a monthly chart, that's where you get actually more concerned about crude. If you pull back from that last like 30 years or so, 30 years, 40 years or so, that's where the big concern comes in. Okay. And you can see why that's a little bit more of a concern, right? Because now you got whatever you want to call it, right? A pennant formation kind of taking place. We don't have to get super fancy, but if you put a volume profile on there, you actually start seeing some heavier dollar flows or heavier volume kind of at these levels on a historical basis. And generally, when we have that breakdown, especially when you have the breakdown of the 200-week moving average, which I talk about that all the time. Generally, when you have a situation like this will fade, and it fades hard. And this is actually a really decent leading indicator of what actually happens with equities. I know you don't want me talking about them, but there's definitely a correlation there on the equity front.
I love it. To talk about whatever you want here.
Yeah.
I don't care.
So this is where if I look at that monthly chart, you get a lot bigger, a lot different perspective than looking at the daily. The daily chart, you say, hey, this thing's basing out, compressing, bop, right to the upside, right? Weekly chart, you're like, kind of at a ledge point, right? Trying to hold, but holding up, you can make a case that it might be trying to break out. Monthly chart, it's like, okay, straight up flag, or whatever you want to call it, pennant, what have you. And unfortunately, you're making relatively new lower lows on that structure there, which kind of leads to the point of a breakdown. Let's bring up natural gas if you can, because here's the real interesting thing about Natty. Completely different. What is that, a daily? Okay, so you got the basing out on the daily. You got the weekly chart that looks better than the daily, right? Breaking above that anchored VWAP that you got at the top. And if we break out to a monthly chart and put a MACD at the bottom of that monthly, dude, I literally owe you like 8,000 Christmas gifts because you are the man doing all of these. All right, that's the monthly. Tell me that doesn't seem like cycle.
It's too good. Yeah.
That's what makes
at
it
this
scary.
point, we all
owe
owe Sam a lot of money.
Yeah, this is what makes it scary to fade Natty. So like in the past, I've been like, hey, $3, Natty gets above 3, you can scalp. And I, full disclosure, I have been. You could do it. It's a lot easier to do overnight. Like that's a hint. Fade it overnight, get out before the before 5 o'clock Eastern time in the morning, because that's usually when you start seeing the short covering taking place. But this looks like actually a cycle breakout that's going to take place. Tell me that MACD has ever failed. If you kind of go back on the monthly, you can go back 20 years, 30 years. Tell me that MACD has ever failed you from a new price. And I want to say new price high, but a cycle high. Remember, these are monthly charts, right? So this means that it's going to take some time here. It doesn't. It doesn't really fade you on those bottom crosses, especially below that zero line. So that's the one I'm like, all right, let's see if this is going to be a new thing. It's an intraday scalp is decent. You got the narrative that's going out there, the expansion of LNG infrastructure being put online between now and 2029, starting to hit the wires a little bit more. You got the administration that's probably going to expedite certain permits to try to get that up and running. And what people don't understand is that as our capabilities in our as the capability for us to export more LNG, or the capacity, right? One way or the other, however you want to. Once the capacity kind of expands and we have that ability to do so, two things are going to happen. Natural gas prices, Henry Hub, will naturally move higher over time. That's going to be a given, because right now it's been so depressed because we have so much of it, we can't really do anything with it. And then if you kind of look at the contracts overseas, they're going to, you got the Dutch contract. Those eventually will actually break lower, right? And we won't have as much of a disconnect like we have right now. I mean, right now we got like a $6 disconnect between prices. So that's the natty gas story. And natty gas is up almost 60% this year, right? So who would have thought? I didn't have that on my bingo card for this year.
And Kevin, I noticed that the apex of that crude oil chart we were looking at comes in around Easter of 2025. Any news we should be anticipating then, or
No, I mean you'll get the
it's gonna be a
blend
surprise?
changeover. You'll get the blend changeover for gasoline like mid-Feb, early March, kind of just depends. You will get before that happens, you will have maintenance, so you'll have synthetically a lot of refiners offline or reducing output. Usually around that time, we kind of get Arctic blast too, so that can mess up the north. So that's when you're looking at North Dakota or the Bakken region being impacted. That was the same thing that happened last year. So that can give you the reason why I bring that up because that's actually a hand-in-hand trade. Like natty and crude will probably be impacted by that, right? So that would be kind of like your like those could be the bull cases. Bear cases, consumption levels are still weak. OPEC can still is adjusting their production targets and growth assumptions to the downside. They're still blaming China. EIA and IEA do the same. And unfortunately, like if you kind of get a break of that shelf of $65, I feel like you're gonna get every bear and their mother is gonna come and pounce on this because like the short interest is not really as aggressive as it was in the past. And so yeah, this thing's really got to kind of hold up here. And if not, we got a problem. That's kind of how I look at it. But y'all, I do have to jump. I'm glad that we were able to do this today. I
Yeah,
hope
me
everybody
too.
has a good holiday, Christmas, Hanukkah, whatever you celebrate. Hopefully you have a great time. And I'll try to get back on here hopefully maybe Friday. I don't know.
Yeah, let me know. You're always welcome, Kevin. Everybody loves to have you. I love to have you. I'll always learn so much. You have a good one. Merry Christmas if I don't see you.
Merry Christmas to you. And, well, here's the last little nugget. Copper looks like a scalp. You got to pick which way though. It's upside. It's upside. All right. See ya.
All right. Yeah. Later, guys.
Getting close there.
Or well, I'm still staying on. So later, Kevin. I mean, but no, I think this is a really interesting, and I think the big thing that we're learning here is, you know, what I said earlier is always important as a trader. Like, sure, as analysts, we can all talk about what we think is going to happen, but really the price action is just what is happening. And volatility squeeze breakouts in something like oil, like that's a very high probability bet. And that's a trade either way. And a couple ways you can do it. Like let's say you really think a move's going to happen in oil today. You could buy put options and call options, buying a straddle, or sorry, yeah, it is a straddle. Buying a straddle, meaning buying calls, buying puts, basically defining that you're only going to lose this much if it moves one way or the other way, and then that trade will make you a lot of money. So going, you know, I would go 6 months out, and if you're a wild man and you want to go a month out, you know, whatever you want to do, but I would go 6 months out, buying calls, buying puts, and literally kind of sit on your hands for a little bit. And that's probably the best trade here, because the one thing I know, I can't tell you which direction perfectly. I can say what I think is going to happen. But what I do know is that this thing is going to move. And that move's going to be either, as Kevin's thinking, it could puke like it did in 2016, or it could just blast to the upside. So that's two different ways of looking at this trade. But you could take the same trade and make a ton of money doing it the same way. What's behind there? What's the red line?
So I threw on the 10-year yield.
Ooh.
So I think if you're making the bet that we're going to see higher yields, we're going to see a new cycle high for yields, then it's really hard for me to imagine a world where crude oil is going in the opposite direction.
That's a great point. That to me is what's really going on here, and what I continue to see over and over again is that yields are moving the wrong way for me to get bearish on oil. Bond prices are moving the wrong way for me to get bearish on oil. Intermarket analysis is the wrong way for me to get bearish on oil. So as long as all three of those things are telling me I shouldn't be bearish on oil, I'm probably not going to get bearish on oil. However, that price action, if it breaks that level, I want to be short on it. But I just think there's so many things that are kind of going on here. The underlying service inflation is kind of saying a lot. What we're seeing in the commodity space, especially the softs, it doesn't matter the CPI. However, it does matter to the world. Like people drink coffee, people use cocoa. It's Christmas season. People are all using cocoa, coffee. Sugar looks like crap out of all the softs. The rest of them look really good. Sugar's the only one that looks like crap. Um, so, and I wouldn't have expected that right now, but it just doesn't look good. And there's a lot of reasons. The basically commodities, a lot of them just come down to supply and demand. There's more supply than there's demand for sugar. And I think as people go to healthier diets over time, it's going to look better. Go back to that cocoa chart, Sam. Let's talk about. We'll end on Sam was right. We
Yeah.
made a post the other day. Yeah, we made a post for the gold rush the other day. So Sam, why don't you start out where you started on this trade idea?
Yeah, I saw a massive uptrend. Let me pull up my RSI profile here, a lower pane. So yeah, massive historic uptrend in cocoa. You got about 250% from the October 2023 low. You don't see moves like that in commodities very often. And this just didn't look like a distribution pattern to me. So I was making the bet that it was more of a continuation pattern, and cocoa had another leg higher in it. And one thing that really tipped me off was the momentum. It failed to get oversold the entire time, and you saw this in the best uptrends this bull market, like Solana specifically. It reminded me of that chart, almost identical twins, but Solana like it rallied 2,500% off the 2022 low, and then just went straight sideways and never got oversold. So that was really the bet I made, is Coco's going to look like Solana.
Nice. No, and so Sam came on the show the other week. What was that? That was, a couple months ago now. And Sam says, "Hey, are you getting long cocoa?" And I said, "I'd be very surprised if I'm long cocoa again." I was in the first trade from, I think we got our signal at the end of November. We were long it into this year. It was a great trade. And I was like, parabolic moves, especially in commodities, don't have a tendency to just move up again. And Sam was like, "I'll fade that all day," And I was like, "Well, Sam, I run if I get the signal, it'll hit. I'll be long it. I'll tell you when I get the signal." I said, "But I don't think it's going to happen." The next day, I have to send a message to Sam saying, "Hey, Sam, I got a signal." So shout out to Sam on that one. And to me, that's kind of why I'm a systematic trader. When you're trading and you're just kind of making guesses, and you're just kind of going into things and just going like, "Hey, like I think this will be this way." It's like when we're talking about oil. I don't have to really think about it that much as a systematic trader. I can go, okay, if it breaks over this level, I'm going to be long it. If it breaks below this level, I'm going to be short it. And it makes it very easy. It's the same way as cocoa. I can't. Sam is out here out thinking the market, which is very hard to do using technicals and also finding those breakout zones himself. It's very hard to do, and Sam is great at it. And so, like, just that either the ability to just take the signal and shut up, the ability to where you just go, "Okay, cool, I'm going to take this breakout," whether it's, and I don't mean everybody has to be systematic. I think you could do it just like Sam did. You follow Coco, you follow one or two markets. For me, systematizing is easier because, or important to me because I trade so many different markets. But if you trade 10 markets and you're looking at 10, 20 different tickers, and you want to go, "Okay, cool, this is a great breakout, I'm going to take that signal," do it that way. But the ability to just sit on your hands and take signals and then go back to sitting on your hands again, not doing anything, that's going to make you a lot of money. And this is a 67% trade.
Yeah, it's been a quick 67% too.
Yes. So great call out by Sam. I wanted to also just shout him out there because that was a really good call out, and a call out on here. We make a lot of trades on here, and I think the very cool thing is Kevin and I and Sam were all people who will be like, "Yeah, I thought this was going to happen. I got it wrong. I think this is going to happen. I got it right." We don't just celebrate our winners here, and I think that's a really great thing about the show. Even something like XLE, we've had some great trades in it over the years, but I thought it would probably move higher after the breakout. Kevin thought it wouldn't. Kevin was right. I was wrong. That's how trading works, and that's why also you don't trade just one thing at a time. If you're a long-term swing trader, you want to be in many different positions. The more positions you're in, the more ability you have to just say, oh, okay, I'm winning on 8 trades. I lost 2 of those 8 trades, or 2 of the out of the 10 trades. So I'm winning on 8 trades. 2 trades are losers. I kept my losers small. You make money that way.
Right. It's all about stacking the odds in your favor.
Yes.
And like being happy to get stopped out. Like, damn, I would take that trade 10 times out of 10, even though I got stopped out of it.
That's the bet. Well said. So I'm sitting there with a friend of mine, and he manages over 100 million, and we're talking about that the other day, and he said the thing about trading and what makes good traders really special is their ability to just go, okay, that was a good trade, even though I lost money. And he said he sat down a client one time, and most of the time our clients, they don't know anything about trading. So he sits him down and he said, oh, that was, I took this trade. It was a great trade. However, it lost money. And most people who don't trade would think that's insane. How does a good trade lose money? Well, there's, that quote by Larry Height, there's good bets and bad bets in trading. There's good bets where you make money, good bets where you lose money, bad bets where you make money, bad bets where you lose money. And what he means there is that the good bets are when you take the trade, you're following your system, your strategy, and you take it and makes money. The good trades where you lose money are the times you take the trade and it loses money, but it's just as Sam said, I would have taken that trade every single time. So I think that's a great way to end it. Want to thank you guys for coming on. I know you guys are all busy with your holiday week. Andy, good to see you, buddy. As always, good to see all my subs in the comments. Please go over to YouTube. I know we have a lot of people on Twitter, but you guys can chat with us on YouTube, ask us questions, and we can answer them for you or bring up charts, whatever you guys want to do. So, all right, guys. Thank you guys so much. Sam, do you have anything to end on today?
No, I'm looking forward to Christmas basketball.
Yes.
Always a special treat for me.
OKC lost. I wouldn't have thought that to the Bucks.
Yeah, that was a really tough loss.
It was a bunch of missed shots. That's happened.
Yeah, it was one game. I still think they'd beat them in a 7-game series.
Oh, for sure.
So I'm not butthurt about it at all.
Yeah, it was good to see Giannis play well. I was excited to see that. I haven't gotten to see him really just go.
They call him the Greek freak for a reason.
Yep, he's a wild man. So it was good to see that.
Yeah.
All right, Sam and I will be on the Gold Rush in a little bit. So if you guys are Gold Rush subscribers, you're going to see the videos soon. And all right, guys, we'll see you soon. Thanks for joining us.